You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home.
And welcome everybody to a Smarter Way Home. We have some wonderful home buying and mortgage financing strategies with a Smarter Way Home. My name is Victor Bals, your host, and my co-host,
Danielle Boote.
Well, good morning, good afternoon.
Good morning.
Yeah. So what are we going to talk about today, Danielle?
We are going to talk about credit, how it impacts your life and potentially your home buying experience.
Oh, yes, it does. It does, in fact, affect that very well. So first of all, let's talk about credit scores. What are credit scores? Some people say, hey, I've got this credit, I've got that credit, I don't have any credit. Explain a little bit about credit scores. What are they, Danielle?
Well, a credit score is a numeric system that grades a consumer's credit history. There are three major bureaus in the United States. We have Experian, Equifax, and TransUnion. Lenders use something called a FICO score. Currently, it is called a FICO 8, but there are multiple types of credit scores.
Such as?
Well, there's something called an advantage score that, for instance, the credit card companies will use, but lenders for mortgages use a FICO score. And there's, if you want to get really complicated, there are different services that consumers can use, some of them for free, which gives them some type of a numeric score on their credit. But again, that is not a FICO score.
Okay. I often get a call and they'll say, oh, hey, I've got a 730 credit score. I just checked Discover. I just checked Credit Karma and I got this. And you lender, you pulled my credit, I'm down to a 680. That can't be right. What do you say about that?
Well, Credit Karma, I mean, to be honest with you, I don't know what number they're using, but no one will give you your credit score for free. So my recommendation to consumers is never to put your social security number in any kind of digital media that you're not paying for. If you really want to know what your FICO score is, I would recommend that you go to annualcredit.com. You can pull your reports for free once a year from each bureau, but they will not give you your FICO score for free. So any of these other apps are not accurate and sometimes will omit older data from the report, which could have significant impact on your credit score.
And a mortgage credit pull is a much tighter pull because it's going to pull everything in.
Correct.
Wow.
The FICO score is not going to eliminate, for instance, an old debt that might have been a collection or something negative because it hasn't been active for the past couple of years.
Okay. So, and how I discuss with my customers is that a credit score is basically a barometer to predict your future based off of your history paying.
That is correct. So let's talk a little bit about what makes up your credit score.
Okay.
30% of your credit score is amounts owed.
Amounts owed on such as what?
Credit cards, student loans, car loans, anything that would show up on your credit report.
So this includes both revolving debt and installment debt, such as a car payment?
Correct. Leases, car leases, things of that nature. 35% of your score is based off your payment history.
Okay.
How well you pay your debts on time.
Okay.
10% will be based off new credit or the age of your credit. 15% of your credit score is based on the length of your credit history.
So if I just open up a brand new credit card last month because I wanted to get that department store 10% discount, that's not going to hold as much weight as an older credit card I had for several years?
Absolutely. And 10% is going to be your credit mix, which is also important. And we can kind of dive into these a little bit, individually as to best practices on how you build your credit.
Okay. So when, many times we've discussed people will shop days, weeks, months for a home, but they never sit down with a lender. And finally, in the 11th hour, they have to get a pre-approval and come to find out they have X credit score and now their interest rates are higher. Could you go into that a little bit on how credit scores affect interest rates?
Absolutely. Credit your credit score is what any lender will use to grade the potential of your loan. Credit scores impact not only the interest rate, but any private mortgage insurance. All of those rates and mortgage insurance are based on your down payment, loan type, and what your credit score is.
Okay, so now what's the difference between, for example, I'm doing a conventional loan with credit scores versus a government loan such as a VA, a rural development, or an FHA loan?
The government programs do not have sliding scales on their mortgage insurance rates. So if you go with the FHA program, they have one rate structure.
For private mortgage insurance, PMI.
Correct. Or in the government world, it's called MIP, Mortgage Insurance Premium. It's all based on that program. It's not a sliding scale in most cases. That is for any of the three government programs, VA, Rural Development, or FHA. Conventional, there are buckets. So there's different buckets based on where your credit score is. And they're usually in 20-point buckets. So, for instance, 680 to 700 is one bucket, but 701 to 720 is another bucket.
So the higher the credit score, the better the rate you get.
Better rate, lower fees.
Okay, Absolutely. Now, and I've noticed on the government loans, it seems like you don't get discriminated against because of credit scores. You seem to get a great rate with a 640 credit score, or an 800 score, you seem to get about the same rate.
Well, there's a little bit of a difference in the government loans. I think that the threshold is about 680 in the credit score. So you might pay a little bit higher rate under 680 than above 680, but it's not going to be as great of a difference as conventional.
Okay, so let's move on and let's talk about some of the negative factors on someone's credit. Let's talk about anybody who has, and I see this quite a bit, is collections, recent collections, or student loans that I see 20, 30 lates on there when they were supposed to be, refigured in and no lates, and we see that all the time. What's your take on that?
Well, student loans are definitely very, very tricky. What I have found over the years is that the Department of Education is not really good communicating with borrowers, particularly when they're in school. They graduate, and the way the federal student loan system is that once you graduate or stop taking classes, your loans will go into repayment in 6 months unless you make arrangements with the Department of Education. So what we'll see frequently is somebody graduates, they don't get any communication from the Department of Education, apparently, and then the loans will go into default. They'll start rolling late payments, and then eventually the loan, within 6 to 9 months, if you haven't made payments, the government's going to put that loan into a default situation. So some of the tips that I give people that are still in school or have student loans is to make sure the Department of Education has a current email and address for you, and make sure that you have online access to your account, and you're very well aware that if you stop taking classes, that loan is due in 6 months. And a lot of times, for instance, maybe students had their parents help them with all the student loan paperwork. They're not really paying attention to this while they're in college, and they completely forget about it after graduation. So even people with good credit have damaged their credit because of the student loan situation.
Wow, interesting. I had a client come in, and we went ahead and pulled a credit, and we seen that there was a $27 collection on his credit report, and his credit should have been 740, but it was down to about a 680 because of this one collection. How many points does a collection affect a credit report?
It really depends on the overall health of their credit. There's not a one-size-fits-all situation here. If somebody has very good credit, well-established, a nice diverse mix of installment debt and revolving debt, one collection might give them a blip, but it might not hurt that bad. But if you have a younger individual who has newer credit, maybe only established for a couple of years, any type of collection could cause a bigger jump. And if there's other issues, obviously that's going to cause more damage to the credit as well.
Yeah, I've seen people who've had a recent late on a mortgage payment. I've seen credit swings from 40 points to 100 points.
Absolutely.
And if you're in a conventional loan, that could take you out of the game, or you could be paying significantly more money to obtain a new loan.
Absolutely.
Yeah,
and one of the difficult things with these small collections, one issue that we see repeatedly is cell phone bills. How many times do people change their cell phone company? No one, including myself, has ever read your phone contract with your cell phone carrier. And there's a lot of fine print there. So you cannot just cancel without potential late fees or cancellation fees and things of that nature. People walk away from the bill, thinking, well, I don't know anything to this wireless company, and end up getting a collection. And based on principle, they're like, I'm not paying that. I shouldn't have had to pay that late fee. And in all actuality, they're just going to damage their credit and will cost them more money in the long run.
It's funny you talk about that, because when we look at utility bills and cell phones, they don't report on the credit when you're doing good, but they're sure there if you miss a payment, and that collection could cost you 40 to 80 points and take you out of the game, or really affect your interest rates. This morning, I thought I would just pull up a scenario. So I went ahead and I pulled up the rate sheets today, and I just gave an example here, excuse me, of credit scores from 620 to a 760, and this is on a conventional loan. And in today's market, we are seeing that conventional home buyers seem to have a higher probability of getting an accepted offer versus the government loans. But so I looked at the rates today, and on a $250,000 loan with just 5% down with that private mortgage insurance, or PMI, with a 620 credit score, today your rate would be 4.25%. Okay. And also the PMI on that would be $268 a month. And that PMI with 5% down stays on that loan for about 90 months before it just goes away. But then I started plugging it in 20-point buckets, but I went up to a 740 score, and that rate dropped from 4.25 down to 3.125, and that PMI dropped from $268 a month down to $48 a month. And so when I ran the numbers, the difference in principal, in interest, in PMI was, you're looking at $385 a month difference payment between a 620 score and a 740 score. And that $385 as a payment, that equates to another $88,000 in mortgage that they could obtain if they had just monitored their credit or worked on their credit prior to buying a purchase.
Wow, that's substantial when you compare it side by side.
Yeah, and I did and just on the principal and interest alone on a $250,000 loan, it's $159 a difference a month, and over the life of the loan, that's $57,000 just because they didn't maybe plan or do something to try to improve credit a little bit earlier in the game.
Yeah, that's tremendously significant to any household.
Yes, and I was just amazed as when we bring customers in, because we have those credit simulators. Why don't you explain what the credit simulators and what the abilities we have to do? Yeah,
we've got some great tools to help consumers that give us very factual data. When we pull a consumer's credit, we get a credit analyzer that comes as part of the report that reviews the credit and gives us potential score improvement. So sometimes we'll pull credit and we'll see a 0, right? Whatever the score is, we have no opportunity for improvement based on the data on the report. But there are frequent times when we see between 25 and 75 points of potential improvement. So what I like to do with my clients, as I said, I call it credit optimization. I said, it doesn't matter where your credit is. If I see that you have a huge potential for improvement, I'm going to review the report in detail. I'm going to share the findings with my client so that while they're shopping for a home, okay, and this is even if I can give them a pre-approval today, while they're shopping for a home, if there's something that they can do that doesn't cost a lot of money, can help improve their scores, I'm going to teach them about that. I'm going to give them the detail so that they can potentially get a better interest rate or lower fees.
So give us a couple examples of how one would improve credit while you run something through an analyzer. What kind of roadmap are you giving the client?
Yeah, well, in our credit bureau system, we can actually go in and pull a credit analyzer report, which will tell specifically the consumer what to do, what to pay down.
Or pay off.
It also has a credit simulator. So if we have questions, we can take that analyzer tool and go, okay, what if we did this? Or what if the client says, well, I could pay this down by $500, but I can't pay it down by $1,000. We can run it through the simulator and tell them this is likely to improve your situation or not. Now, the big asterisk with any of these credit analyzer tools is, of course, what the consumer is doing on a month-to-month basis. Credit scores can change daily. Typically, they don't necessarily move daily. It all depends on when their creditors report. So we have to really look at the fine details of the report. When are the creditors next reporting? What is the consumer doing? So for instance, I've had people that have taken this credit analyzer tips and done really well with it in 30 days or less. But I've also had people follow the instructions, but then they do something else that they don't tell me about, and it blows the plan completely out of the water.
Absolutely. Yeah, I've had some clients in, and we put it up on the big screen, and we actually do that simulator, And I say, so what do you think you should do with your credit? They go, well, I tell you what, I'm going to pay those credit cards off, and I'm just going to close them out.
Yeah.
And I go, okay, let's simulate that. So we'll pay that credit card off and close them out. Their score actually drops.
Yeah.
And then they said, well, how can that happen? I go, because it's a very sensitive tool. Because, a lot of people get advice, hey, just pay those credit cards off and close them out. Get rid of them. You don't need it. And that's the actual wrong advice they can get. So in many cases, we'll start playing around with it and pay down this credit card to X amount, and we'll also measure it if we paid it off to zero. And sometimes when you pay it off to zero, it actually hurts your credit score rather than keeping a $10 or a $25 balance on that.
Right, and everybody's situation is unique. How long have you had credit? For young people, let's say in their 20s, it's going to be more sensitive because they have less history. Somebody that's older is going to have maybe less fluctuation, regarding those scores because they have a deeper history. I had a client a couple years ago, pre-approved this young man, took him a year to find a house. And when I first spoke to him, he was 760 range, which was excellent. Mm-hmm. Okay. I told him, don't do anything, continue to pay your bills on time, keep everything up to date. And took him 9 months or a year to find a house, and he calls me back, and I go, okay, great. Yep, here's your updated pre-approval letter. We're going to rerun your credit, write this offer. And his credit score dropped 80 to 100 points. Like, I was in shock. He didn't have anything late. Well, dive into the credit report. And what this young man did was he paid off all of his student loans, thinking he was proactive. He paid off his car. He paid off his credit cards and closed them.
So now we have nothing to measure this guy
with. And he had
with.
one minor collection from a it was something. It was like literally a $50 bill from medical or something. I don't even know. And his scores tanked, which made it. He got a mortgage. It was obviously more expensive. He wasn't happy.
Did you have to move him from a conventional loan into a government loan?
No, believe it or not, he had 20% down. So we were able to keep him in conventional, but I talked to him even a year after that. So even a year later, after he's now got a mortgage on his credit report, his scores were not over 700 again. And this is a young man. I mean, he was in his mid to late 20s, so he was established, but he didn't realize that he closed everything, right? You pay off an installment loan, it's now closed. You pay off student loans, they're closed, and because those are installment loans. And then the credit cards, he literally shut down all of his history, and then you sprinkle one little collection on top, and he had nothing left.
Let's talk about that little medical collection, because I have a lot of people telling me that, that is my insurance company, my medical insurance was supposed to pay that, and I'm not paying that because of just the principle. But that ends up costing. What would you recommend that client do in that situation?
Well, first of all, anytime someone gets a medical bill, okay, whether the insurance company is supposed to be paying it or not, I would recommend that you call the hospital or medical provider and see if they will set up a payment plan. If the balance on the bill is $250 or more, the medical provider will typically set up a monthly payment plan and they will not charge you any interest. So even if you've got to deal with arguing with your insurance company to get the bill paid, you can make sure that you're meeting a minimum obligation from the hospital. If the medical provider gets overpaid, they're going to refund the money to you, right? But you're at least protecting your credit so it doesn't go to a collection status. I mean, I've used that tool myself throughout the years. Years ago, my daughter had her appendix removed. It was an emergency surgery situation. I think we owed over $10,000 in copays and deductibles. I think it took me 4 years to pay it off at that point in time. Yeah. But I didn't damage my credit for it. But most people just bury their head in the sand and don't look at it. And this is where, as you said, meet with a loan officer for an hour before you go shopping, because people don't know when you're going to have surprises out there.
And this isn't meet with me today and tonight we're putting in offers. It's
correct.
Probably 30, 60 days and get the client educated, one on credit and mortgages, I would assume. Yeah.
I had a couple years ago come to me for a mortgage, and they knew that they had excellent credit. So I literally sit down with them face to face, pull their credit. We're doing the pre-approval, and the wife's credit score had fallen to under 600. And now I'm sitting face to face. The husband's credit is excellent, but now I have to carefully look at the report and find whatever's going on, and now report this to them. What occurred in their situation was that the wife had paid off her student loans and didn't pay attention to the final interest payment. She had it set up on auto pay. And what had occurred with her is the last auto payment happened. The final interest billing came due the following month for a smaller amount, but the auto pay didn't transfer to that final interest payment. Now, don't ask me why that occurred. I thought that was ridiculously stupid. But then she had a collection for like $100 on a student loan that she, So in that situation, to protect the family, we ended up having to take the wife off the loan. Now, she did, and she paid it off immediately, but it still would damage her credit in the short run.
And how long will that affect her credit?
I think, minimally a year.
Yeah.
Minimally a year. And then at that point, she wasn't even going to be on the family mortgage anymore. So, I felt horrible. She was like in tears. She couldn't believe it. But I could tell from their credit, everything was perfect. It was just, you hate to say an honest or a stupid mistake, but again, she didn't get anything from the student loan company apparently, or if she got it, she didn't pay attention. So that's kind of an important tip too. Anytime you pay off a loan, especially any type of revolving credit, there's always going to be a final bill, potentially with a little bit of interest from the previous month. So don't ever discard that final statement or whatever. Open it, make sure it says 0 so that you don't end up with a headache. I've seen the same thing with people that turn in lease vehicles and stuff like that. They get
that last charge.
Last charge for the ding on the windshield or something. And again, that goes to collection very quickly.
Let's talk about authorized user accounts. They're double-edged swords, the way I look at it here. And I'll have a client in and we pull up his credit and I see, you got an authorized, and his credit may be low, but I look and I say, this is on that authorized user account, meaning this could be mom's or someone else had put my client on as an authorized user. They don't get a credit card for it or nothing. They don't even get the account number. But if the person who authorized them doesn't make their payment and there's a 30-day late, it's going to affect you, the consumer. It's going to affect your credit too. And when we run these simulator tools, sometimes we could say, well, what happens if you close out that authorized user?
Or remove it.
Or remove it from the account, because all the consumer has to do is call the credit card company and say, hey, remove me from that account. I don't want to be on there. And boom, we see the simulator, and all of a sudden they raise up 40, 50, 60 points, in some cases 100 points. So a pretty cool tool. And I don't think the consumer understands a lot about those.
No, because I don't know if you recall, maybe 10, 15 years ago, putting someone on an account as an authorized user could help establish credit. The rules have changed in the last 10 years because I think the credit bureaus wised up and said, wait a minute, this isn't a good practice. We don't want to give people an artificial credit score. So now the authorized user situation does not always impact the FICO score. And in some cases, you're correct, it'll pull it down. You know, and the one big thing that most people don't realize is it's especially with like a credit card, which is where we'll see an authorized user situation. What weighs heavily on the credit score is your debt utilization. So
what does that mean, Danielle?
Debt utilization is the balance compared to the credit line limit. Okay. So here's an example. You have a $500 credit limit on a credit card, and you use it monthly and pay it. Even if, whether you pay it off or not, you're putting $500 on it every month, okay? The bureau is going to read that you are maxing out that credit card monthly.
Okay.
So the tip with revolving credit is ideally you want to keep the balance of 1/3 of the available credit limit.
So about keep that $500 credit card no more over maybe $150.
Correct. Okay. Which that's barely using it in today's day and age, right?
Yep.
So for instance, if you had a $10,000 credit limit, then you want to keep that balance under about three grand. If you go over 50% of your debt utilization on a card, then you're going to see it start to pull the credit score down.
One of the examples I use is I go, think of a credit score. Think of you as a lender. A credit score is basically an opinion of you and your ability to pay. And Danielle, if I ask you, I said, hey, Danielle, can you give me a credit line for $1,000? And you say, yeah, sure, Vic. But I go out and spend all that in the first 30-day cycle. What's your opinion going to be of me? Like, wow, can this guy manage money? I don't know. My opinion's a little concerning, meaning this is going to drop my credit score. Such as if I go ahead and take that $1,000 and I only spend a couple $100 and I pay it off, you're going to, if I come back to you for more credit or just your opinion of me is saying, oh, I manage my money pretty good, your opinion's better, thus raising the credit scores. And people seem to connect to that type of analogy on that.
Right. And a lot of times younger consumers trying to build credit will go and open 2 or 3 credit cards.
Okay. Is that good or bad?
Well, it depends. So if you open too many cards at the same time, that's going to be deemed a negative. But what also frequently happens because they're building credit is that they get a small credit limit, for instance, $500 or $1,000, and they're using all 3 of them. So it looks like you've got 3 new cards that are all maxed out. That's going to be a negative. Now, if they open them and they're careful, use them and pay them. One of the things that consumers will ask is, well, should I keep a balance on it or should I pay it off monthly? Now, I don't want anybody to pay credit card interest, but one of the tools that's important to figure out is when your creditor reports to the bureau. They only report once a month, okay? Now, if you pull a copy of your credit report yourself, for instance, for free from annualcreditreport.com, you will get the data. You will know when your credit card company typically reports. They report 1 day a month. So even if you pay that bill off monthly, but they report on the 25th of the month and your payment's due the 28th and you pay it the 28th, they're going to read it on the 25th as whatever the balance is that day.
Yeah, so they got to wait till next month to report that current thing.
Correct. So, but then it always looks like you have a balance.
Right.
So for one of the credit optimization tools that I love to tell people is, look, find out when your creditor reports, and if you pay that bill off monthly, pay it off a day or 2 before you think they're going to report.
So every time they report, it's showing you got
a lower
near
balance.
A zero balance, thus raising their opinion of you, thus raising your credit scores.
Correct. That's, that's, I would say, a trick of the trade when it comes to debt utilization.
Yeah, that is kind of cool.
Which is most where most people get in trouble.
Okay, there's 3 credit scores. What do lenders use and why?
We use an actual FICO score, and we are going to take the mid score of all 3 bureaus. So we throw out the highest and we throw out the lowest. We don't average them.
Okay.
We just are going to use the middle of the 3.
So as we talk about, I get this question a lot is, why do we have 3 credit scores? Well, why is there 3 different ones?
credit bureaus have been around probably close to 30 years is when we started using the FICO score tool. I think the bureaus, I'm sure, have been around a little bit longer than that. I don't know why we have 3 in the country, to be honest with you. My guess is they all have slightly different algorithms on how they determine what the FICO is. And it's probably for a fairness indicator, right? So that if there was one bureau and there was a mistake,
It's like getting 3 quotes.
yeah, if there's one bureau and there's a mistake, you have a less chance of fixing it.
Well, you talked about the algorithms, and so we have Experian, Equifax, and TransUnion. That's where we're pulling from. And to try to put this in layman's terms, there's about 40 different codes that a credit reporting agency such as Experian may use. And out of these 40 codes, just for example, on an Experian, one of their codes is code 1, amount of owed on special accounts is too high. Another code, length of time revolving accounts have been established. The length of time accounts have been with no revolving credit debt. And so these are just 4 of the 40 on Experian. That's the 4 that Experian uses. But Equifax may use another one of those codes, no recent revolving balances. That's a different code number. So these 3 bureaus pick 4 of these 40 codes each, and that's why we see these different credit scores, because it's a different modeling type of based off of your behavior patterns.
Now, one of the things, too, that's important for consumers to understand, because they may look at their 3 scores and go, why is there a huge difference? We've got two that are higher and 1 that are lower. Well, most big banks or creditors will report to all 3 bureaus, but they're not required to. You may find smaller banks that own or lenders that only report to 1 or 2 bureaus. Sometimes collections will only report to 1 or 2 and not all 3. So that's where you'll see a disparity in the numbers. I mean, they should be, theoretically, your credit scores should be all similar.
Yeah, very close. Yeah,
they should be close.
Yeah.
Okay. But you could see a 100-point swing at times because, for instance, a collection pops up, they only report to 1 bureau. And you're going to see 1 score that looks like the outlier, right? It doesn't match anything else, but when we dig into the report, we can see.
Yeah, and we see that happening because a lot of like automobile retailers, when you go to a dealership, they pull from one particular bureau,
Correct.
And they, let's say, for example, they pull from TransUnion, and if you had a collection that's only reporting on TransUnion that could be faulty, you could be paying higher interest rates on automobiles too.
Correct. Yeah, that's very common, and that's a good point to bring up. I've also seen over the years, there's some small banks, maybe credit unions, I'm talking very small, very local lenders, and I've seen consumers be very loyal because, hey, this is the bank everybody uses in town. It's XYZ, town bank, and they report to 1 bureau. So when they come to get a mortgage and they say, my credit's really good, and I pull their credit, and guess what? They only have 1 score because all of their credit was concentrated with 1 lender, and there's no diversity, and that lender doesn't report to all 3 bureaus.
How many credit scores does a consumer need to obtain a mortgage?
2.
A minimum of 2.
Minimum of 2.
And when they only have 2, what score will they use, the high one or the low one?
We'll use the low one.
We'll use the low one. Okay, and then how would you counsel people, hey, I don't have credit, I pay cash for everything, and I pay my rent on time, why can't I get a mortgage? What do we do about the people that have no credit at all, or no scores?
There are occasionally lending opportunities for people that truly have no credit scores if they can demonstrate that they have a history of paying rent and utilities on time. Honestly, we don't run into too many people like that because most of the time when someone says to me, I have no credit, and we pull the credit, guess what? There's something out there, whether it's medical bills or, collections from the wireless company or something of that nature that they didn't realize were going to be on the credit. And if they have old bad credit, that's not going to help much because they're not going to have good scores.
Well, and sometimes we have people that we pull their credit, and we have some very low scores, maybe just sub 600 scores. And we tell them, well, you got to get more. You got to build some credit. And they say, I've been turned down from all the other creditors. What do you recommend? And then I always talk about secured credit cards is a great way to build credit. Can you explain what those are?
Yeah. So a secured credit card is a situation where a borrower is trying to build credit or fix credit, where a bank will let them make a deposit for such as collateral. So let's say you give the bank $500.
And they open me up a savings account, basically.
Kind of. It's not really a savings account, but they'll hold that money as collateral, and then they'll give you a $500 credit card that you can use and responsibly pay.
And if I don't pay it?
They've already they're not out the $500 because
it's your money.
It's your money that they're holding. So that's what a secured credit card is. Another option that I have shared with people over the years that works really well, and this is a tool that most credit unions will do, you can put money in a certificate of deposit or a CD, interest-bearing account. You put the money in the CD, lock it up, then you go and get a loan using the CD as collateral. And that would actually be an installment loan. So here's how that would work. You put $1,000 in a CD. Yep. Yes, you're going to earn interest on it. You take out a loan, personal loan for $1,000
from that institution,
and it's an installment loan, so that's going to have a different weight than a credit card with a monthly payment. And even if you paid it off in 12 or 18 months, you're going to pay a little bit of interest on the installment loan. You're going to make a little bit of interest on the CD, but now you have a trade line. So you literally can give them $1,000. Take a loan for $1,000, put it in a savings account, set up auto pay on your loan, and start paying this on time. And that helps create a good credit history. I mean, ultimately, for someone that's building credit or trying to repair credit, we want to see 3 or 4 accounts that have been open and paid on time for at least a year.
What if they were closed? What if they had some trade lines, but they're closed because they paid off that car? They did that. Does that still count as activity towards their weight to get approved for mortgage?
It can, as long as there is other activity that still has credit. So I have a great story of probably about 5 years ago. I had a client come to me, and she, gather her information. She's got good credit. She's got a good job. She's got money saved. Really excited about buying a house. And I pull her credit, and she has no scores. So I look at the credit report, and she has credit, but everything was paid off. So she had student loans, paid them off. Had a credit card, paid it off and closed it. She even had a car loan, paid it off. So I had to call her and I said, hey, you don't have any credit scores. Here's what I see going on. I said, do you really have nothing open right now in your name? And she said, no. She goes, I graduated college. I lived at home for a while, paid everything off, rented an apartment. Here I am. And I just didn't think I would need credit again because I knew I would never spend more than I could afford, to spend. And I said, well, here's the problem. You had no activity on your credit report for 6 months, and the bureaus zero out your scores.
Because I haven't used my credit card in 6 months thinking
it was closed. Nothing was open.
Closed it out.
No, the consumer closed everything out. So she literally had nothing open, nothing active. And when you go 6 months or more, the bureaus basically shut you down. Now, it could also somewhat be for a fraud protection. So I looked at that situation and I said, well, you've got good credit. Here's what I need you to do. So I sent her to her credit union where she banked. I said, you need to go in there and open a credit card and ask them how quickly they're going to report. And she went and did that. And of course, they had no issues giving her credit because they knew she had a good history. And I think it took 2 weeks for the credit bureau to report the new account, and her credit scores were above 720.
Did it report on all 3 bureaus?
Yes.
Wow, that's interesting.
Yeah, so we literally had taken her from 0 to above 700 quickly, but she had nothing negative, right. And it was just a matter of keeping something open.
We had to kickstart her credit, yeah.
Yes, and honestly, I think this, again, was about 5 or 6 years ago. I had never seen that happen in my entire career. And in that case, what was good was that all of her past credit was excellent. And she had about a 10-year history there. Right. So the bureaus were able to recognize it. Now, if you had negative credit at all, it would not have worked quite as successfully. But a lot of people either think, yeah, I don't need credit. And we're not recommending that people use credit irresponsibly, but you can't not have a credit score these days.
Yeah, you need to. Yeah, unfortunately, you need to use your credit so it keeps your scores up. Because I've seen clients where credit card companies have closed out their account without even the borrower knowing because of no recent activity in 6 months. They'll close them out.
And I've had clients ask, well, look, I'm not really going to use, let's say you lived on a different part of the country. You lived on the West Coast, you moved to Michigan, and you had a store card in California that doesn't exist here. Right. Well, no, you're not going to necessarily want that card open forever because you're not ever going to use it again. But you can close things out. You just have to do it very strategically. Do it at a time. As long as your credit is good and it's solid, closing out one card's not going to hurt. Closing out 5 cards in the same month is going to be a huge problem because the bureaus don't really read that the consumer is closing it versus versus the creditor closing it. And why is the creditor closing it? Again, if the creditor's closing it, it looks like it's a problem, regardless of it's an inactive account or not.
Well, and one thing Danielle and I have to do is emphasize that we are not credit counselors. We don't do credit repair. But we have both been around the block for a long time, and we probably review 1,000 credit reports a year between us, and we just see these patterns, and we have these tools. So we want to make no claim that we are credit report experts or credit reports or credit repair services in that too.
Yeah, there are reputable companies that, of course, can help with that we can refer people to if they need more help than they can accomplish themselves. But, most of the times we see little things that can be improved in a short period of time.
Yeah, because we could save you tens of thousands of dollars in some cases, but you need to get smart smarter as a consumer. Remember, you didn't get into that overnight. You're not going to get out overnight.
Right.
And if you're going to buy a home, sit down with a loan officer before you shop. Let's get a good profile, see if there's any improvement and let's optimize your mortgage potential here.
It's all about saving money and getting you the best situation. Right. There's times where we can get people into a mortgage and in a year we can refinance them and get them a better rate or lower PMI, of course, if they do the right things and, build their credit differently. But that's an option. But when you look at the fact that, do you want to pay $300 a month more for that house today?
Just to get it,
Right. Again, being prepared. And I think it's important for consumers to know their credit scores.
Oh, yeah.
And, if you pull your credit at annualcreditreport.com, it's considered a soft pull.
Right.
Because you're the consumer pulling your own credit. It doesn't come up as a lender as a hard pull.
That's another myth there that we want to talk about because people often call me, well, is this going to hurt my credit scores? And I explain them when we pull for a mortgage loan that you can have up to 9 credit mortgage pulls in a 45-day period without it affecting your credit scores. It's when you may go down to the local car dealer and apply for a loan for a car, and they broker it out to try to find the best rate, that every one of those pulls could potentially cost you about 4 points, or every time you open up a revolving credit card or there's an inquiry on your credit, those can potentially hit you about 4 points a piece.
Right, but I would rather, and this is, I guess, my personal opinion, I would rather have a consumer actually know their FICO score. If you want to shop for a mortgage, that's great. But I wouldn't tell anybody to have 9 mortgage companies pull your credit report. Because here's the thing that it comes with the credit inquiries. If you've got really good credit, 1 or 2 inquiries isn't going to hurt you.
Right.
But the issue becomes when consumers have moderate credit, and then they have 3 or 4 companies pull the credit, and then they wonder why their scores are impacted.
Right.
Because if they're, a lot of times people are shopping for a mortgage, shopping for a car, and opening credit cards all at the same time. So, that is definitely that can be problematic. And if your credit score is in that more moderate range, it's going to be a bigger impact than if you've got really good scores.
So my advice is if anybody's shopping for a mortgage, concerned about pulling their credit and, I'm going to lose some points, maybe you need to do that anyway, and maybe we ought to get you a good reality check here to find out where we're at and how you can improve.
Right.
Sure.
Or get yourself, you want to buy a car and you don't know where your scores are. Why don't you go to, you can get a credit approval to buy a car outside of the dealership.
Right.
Unless you really want to finance with the manufacturer, or, lease from the manufacturer, obviously that's a different story. But, get your own financing, then go shop for a car, and you're in control, and you're not going to have 22 inquiries.
You made a comment there that, we can get your mortgage done with moderate credit, but, you are going to pay a little bit higher rates or higher cost and higher private mortgage insurance. And sure, we can get you in that house and hit that objective and potentially refinance when the credit goes up. And that's great, but I just want the consumer to be aware that, there's another set of closing costs that you got to consider. That's going to cost. And what will interest rates be in that next year or next 8 months whenever you decide to do that? So there's some moving targets. So in the case where you have moderate credit, maybe we got to get you in that house. We use that particular mortgage as a Band-Aid until we can put the stitches in for long-term gains.
Right.
And I tell
But again, it just is starting earlier.
Yeah,
Don't fall in love with that house and then go, I need a pre-approval now. Get started earlier. We can evaluate your situation, make recommendations that are right for you and your family so that you're prepared.
Yeah, if your credit had taken a couple hits, the way the lenders are going to look at it, you want it to dance, now you're going to pay the fiddler, because so get in early. And if you got any questions, give us a call. And any closing words, Danielle? At all?
Credit is very unique and consumer to consumer based. So I would caution people to be very careful talking to the FBI,
the
friends,
fathers, brothers, and
in-laws, and or reading things on the internet. I think that consumers read A, B, C, D, E, and then sometimes you'll get conflicting information. You're really not doing yourself any help. I mean, I've had people that aren't sure where their credit is. I'll tell them to bring me a copy of their credit report if they don't want an inquiry, go to annual credit report. Pull one of the bureaus, bring me the report, and then I can help analyze it to kind of give them some tips and suggestions on what to do. But just be careful who you're listening to because most people don't have the right answers.
I absolutely understand that. Well, that wraps up today's show, and we want to thank you, Danielle. Thank you for coming aboard
You're
here
welcome.
today.
Thank you, Vic.
And we just want the consumers to know, get face-to-face with your lenders. Obtain that reality check credit. Look at it, analyze, try to optimize the best for you. And with that, I just want to let everybody know that this is a smarter way home, and we all got to come together and try, and we'll see you next week on A Smarter Way Home.